Welcome to the deep dive. India isn't just rising anymore. It's really carving out a dominant space in global manufacturing. It's becoming this undeniable economic powerhouse. And right at the heart of this incredible surge, there's a company you really need to know about, Jyoti CNC Automation. Forget Hidden Gem. These guys are a shining star, top 10 globally for CNC machines. And these machines, they're the precision workhorses, right? They craft pretty much everything around us, airplane parts, car chassis, you name it. But today, we're embarking on a deep dive, getting into Jyoti CNC Automation's Q1 FY26 earnings call. Our mission, pretty clear. Pull out the vital insights, their business segments, the industry outlook, their future strategies, which look pretty build, and crucially, the key risks they're actually navigating right now. So what can you expect? Well, get ready for a story of, frankly, explosive growth, some really strategic moves for global expansion, and also the intricate, very real challenges of scaling up a high-precision manufacturing business in what's a constantly shifting global landscape. It's going to be a fascinating journey for us all, I think.
Okay, let's start by setting the stage, the macroeconomic picture, but seen, directly through Jyoti CNC's eyes. They observed that many developed economies are, wrestling with high inflation and sluggish growth. That's a tough combo. And then you layer on top of that the persistent uncertainty, from new tariffs, ongoing trade disputes. It makes for a pretty challenging environment for global businesses.
Right. And what's truly exceptional here, it's a really striking contrast, is India's performance against that backdrop. While many places are slowing down, India isn't just growing, it's projected to sprint ahead. We're talking 6.4% growth in both fiscal years, 25 and 26. That's not just good. It really cements its position as one of the fastest growing major economies globally. And to back that up, look at the manufacturing PMI, the Purchasing Managers Index, for July 2025. It stood at a very strong 59.1. Anything over 50 means expansion, right? And India has been consistently above that. It just signals this aggressive growth and reinforces its role as this growing manufacturing hub for, everyone.
Okay, so India's booming. But, despite that strong domestic picture, Jyoti CNC specifically highlighted an immediate challenge for themselves. They said they need to closely monitor the geopolitical situation and those ongoing tariff issues. Now, is this just standard corporate caution, or
A good question.
or does it signal something more, like a genuine vulnerability, especially given their manufacturing presence outside India and France?
I think it's more than just caution. It really highlights this unique tightrope walk they're on. On one hand, they're incredibly well positioned to leverage India's strength, right? Tap into that domestic growth. But through their operations in France, they're also directly exposed to all those global uncertainties. This interplay, the global and local, it isn't just academic. It dictates where they invest, how they manage their supply chains,
Right.
and ultimately their profitability. And for you listening, this matters because it shows how even super technical industries like this are deeply tied to geopolitics and economic shifts. It impacts jobs, availability of goods, everything.
That's a great way to put it. So, with that macro picture set, let's zoom in on Jyoti CNC itself. Who are they really? I mean, beyond being a global leader, this is a company with state-of-the-art facilities, not just in Rajkot, India, but also in France. And combined, these places can churn out over 6,000 machines a year. It's impressive capacity. We're talking decades of R&D, world-class manufacturing. Puts them right on par with global standards.
Exactly. And their market reach, it's incredibly diverse. That's a huge strength. Jyoti CNC machines are absolutely crucial in so many sectors: aerospace, defense, automotive, electronics, general engineering.
Wow.
This broad application just shows they can handle diverse, often really complex demands. And we have to mention their strategic partnership with Huron,
Ah, yes, you're on.
a global leader in high-precision machining. That gives them a tech edge, sure, but it also accelerates their international expansion, especially into Europe.
That is an impressive breadth. Okay, let's get into the numbers from their Q1 FY26 call. How do these sectors actually translate into business? First up, revenue split for the quarter. Auto and auto components brought in 36%, aerospace and defense a significant 30%, general engineering was 26%, and then others made up the last 8%.
Okay, pretty balanced across the top three there.
Yeah, but look at the order intake for Q1. Aerospace and defense actually led the pack, 33% of new orders. Then came auto components at 31%, general engineering at 29%, and others with 7%. A slight shift in new business focus, perhaps.
Seems like it. Aerospace is definitely strong.
And then there's the current order book. It's really robust. Standing at 4,412 crores. That's about 44 billion Indian rupees. Huge backlog. And the breakdown there is even more interesting. Aerospace and defense leads again, surprisingly large at 39% of the total,
39%. Okay.
followed by general engineering at 19%, auto components at 17%, and then this rapidly emerging EMS segment, electronic manufacturing services, that's at a promising 16%.
EMS at 16%, that's significant.
Right. Then die molds at 4%, and the rest from other segments.
You know what's really fascinating here, and this is critical for you to grasp, is this isn't just a simple shift in orders. It feels like a strategic de-risking move. They're dominating in high-margin, less cyclical sectors like aerospace and defense.
Right, which now leads their backlog.
Exactly, and they're rapidly growing into that booming EMS sector. They're not just chasing overall growth, they're insulating themselves from volatility in, say, the auto sector.
That makes sense.
It positions them for sustained quality growth, even if the broader manufacturing climate gets choppy. It's a calculated move to be indispensable in India's, high-tech industrialization.
That's a brilliant frame. And it ties right into profitability, doesn't it? They categorize their machines by value, which, as you'd expect, links directly to gross margins. Their entry-level products machines up to maybe 50 lakhs, ₹500,000, they get gross margins of 35% to 40%.
Okay, standard stuff.
Move up to mid-range, and you're looking at a healthier 40% to 47%. But here's where it gets really interesting. The high-end machines, especially for aerospace and defense, those yield the highest margins, 55% to 57%.
Wow, that's a big jump, 55 to 57%.
Yeah, so it shows that while volume matters, the value of the machines they sell, driven by that strategic focus on high-precision, complex stuff, is a huge engine for their profit.
Absolutely. Mix matters a lot.
You know, what really struck me going through the call was how Jyoti CNC isn't just like riding India's wave. They seem to be actively charting their own path. Quite audacious, really. They're not just reacting, they're shaping their future with some pretty bold strategic moves. What did you make of their growth plans?
Oh, absolutely. Their future strategy is multifaceted and definitely aggressive. Let's start with capacity expansion. Current utilization is around 75%. Healthy demand, right? But they're not stopping there. They plan to significantly ramp up annual capacity from the current 6,000 plus machines to a remarkable 10,000 machines per year.
10,000. By when?
Aiming for September 2026. And what's key here is this expansion is largely for entry and mid-level machines, specifically targeting high-growth areas like EMS.
Okay, so targeted volume.
Strategically targeted volume, exactly. They're not just building more for the sake of it.
And speaking of EMS, their focus there is almost a whole story on its own, right? They approved buying 20 acres of land, 20 crores, in Tuguru Mahindra Park down in Karnataka. Now, this isn't for making more CNC machines directly, is it? It's for support centers, tech centers, a warehouse. What's the thinking there? And this PLI scheme thing.
Yeah, it's a brilliant move. It's about getting closer to their customer cluster in southern India, which is a real hotbed for EMS. It means being more responsive, better service, fostering innovation right where those high-growth customers are located.
Makes sense. Proximity matters.
And the PLI scheme, production-linked incentive, that could be a game changer. They're exploring eligibility. If they qualify, the benefits are significant. Think 25% CapEx subsidy from both central and state governments.
Wow.
Plus potentially 6% back on sales. That massively improves the financial case for this expansion, basically subsidizing their strategic push into EMS.
Okay, huge potential boost there. And beyond domestic stuff, they're clearly looking internationally too. The board approved setting up sales and service networks in the USA and China. What's the strategy behind that? Especially China, given it's such a huge market and they have Huron.
Well, the rationale is pretty clear and quite smart, actually. China is the world's largest market for these machines, and their partner, Huron, already has a substantial customer base there, including government clients, which is important.
Leveraging existing ties.
Exactly. It's not just expanding geography. It's tapping into existing relationships and serving both current and new EMS customers globally. For the U.S., it starts with sales networks, but they left the door open for small assembly plants later if tariffs or opportunities make sense, similar to the Huron model in Europe.
Flexible approach then. And quickly on Huron itself, the new French facility for those big high-ticket machines is coming online this September. But they noted, due to long lead times for those complex machines, significant revenue growth from Huron won't really kick in until next fiscal year, maybe Q1 FY27. It's a longer play.
It is a long game for those high-end systems. But if you connect all these dots, the land buys, international expansion, the massive capacity boost, It signals Jyoti CNC's unwavering commitment to aggressive diversification. They're smartly tapping into high-growth sectors like EMS, cleverly leveraging government help and their existing partnerships. It's not just about making more, it's making smarter, closer to key customers, and really positioning themselves as indispensable in future global
A
manufacturing.
very clear roadmap.
Yeah, a calculated one for solidifying that global leadership position.
So, okay, we've painted a picture of ambition and strategic moves. What does this all mean for the road ahead? The outlook seems positive, plans are ambitious, but like any fast-growing company, they face real challenges, real risks. What do you see as the most critical risk for them right now, given that strong order book?
That's an excellent question, and it points to a common challenge, especially in high-precision manufacturing. The primary risk, interestingly, isn't really demand or getting orders, like you said. 4,412 crores in the order book is huge.
Right.
The main challenge is execution,
Execution, meaning
meaning significantly scaling up their team size and, crucially, developing the skilled labor force needed for this high-precision work. Imagine you're an aerospace customer needing a complex machine. You probably can't wait 2+ years for delivery, right?
wait, not in today's market.
Exactly. So their ability to deliver faster directly impacts competitiveness and growth. They know this, they're focusing hard on training and expanding the team, but it's a monumental task.
Skilled labor, always the bottleneck in precision fields. Okay, what about cost management? Gross margins actually improved nicely, up 270 basis points year over year to 55.9% in Q1. That's good. But EBITDA margins dipped slightly, 26% down to 24.4%. You mentioned employee costs.
Yeah, that was the main driver. The EBITDA margin dip was mostly due to higher employee costs and extra 15 crores year over year for manpower as they scale up. But management expects this to kind of balance out. As revenue increases from the new capacity and they get more operating leverage through the year, it should normalize. And on a positive note, remember that 16 crore forex gain in Q1 from the euro appreciating, that helped their other income line.
Right, a nice little cushion there.
Yeah.
It's also worth reminding everyone Q1 is typically a seasonally softer period for this industry. Yet despite that, Jyoti CNC reported really strong numbers, 13.4% consolidated revenue growth, and a significant 40.2% jump in profit after tax for Q1 FY26.
Yeah, even in a softer quarter, that's impressive growth.
So definitely showing strength. And a stronger second half of the year is generally anticipated following those typical industry patterns.
Mm-hmm.
And one last thing, their financial discipline really stood out. They seem committed to a very disciplined investment approach, planning to fund all organic CapEx through internal accruals and debt. They explicitly said they don't see needing external capital.
That's a strong statement. Shows confidence in their cash flow.
And they're actively working on improving their working capital cycle, aiming to cut it from 175 days down to 150, 160 days this year, which, for listeners, basically means getting cash back from investments in inventory and receivables faster, more efficient cash flow.
And that financial discipline, focusing on internal funding, improving working capital, it provides a very strong base to manage those execution risks we talked about.
Right.
Ultimately, it raises that key question for you to think about. How effectively can Jyoti CNC scale up its people, its human capital, and its operational efficiency to really cash in on these ambitious plans? It's about matching that strategic ambition with the sort of nuts and bolts reality of high-precision manufacturing. Their financial prudence definitely gives them an edge there.
What a journey through this earnings call. Our deep dive really shows Jyoti CNC. Automation is at this fascinating point, isn't it? Riding India's manufacturing wave, making these incredibly savvy strategic plays both at home and abroad, and also actively, quite transparently, managing these very real challenges in scaling and execution. What's the biggest takeaway for you from our chat today?
For me, it's the picture of a company meticulously balancing these huge global ambitions with a really sharp operational focus on the ground. They're leveraging partnerships, government support, building this robust foundation for sustained quality growth. It demonstrates a really clear vision for where they want to be in the market.
So here's a final thought to leave you with. As these global manufacturing dynamics keep shifting, how might companies like Jyoti CNC truly redefine what Made in India means on the world stage? And, perhaps more intriguingly, what new, maybe unforeseen opportunities might this unlock for them, even beyond the areas they're focused on right now? Something to ponder.